Welcome, friends. We are continuing with our journey, deep diving into financial coverages in this series of fundamental analysis. Under the financial ratios analysis, yesterday we have covered the profitability ratio. We have analyzed that one. Today, the second part, we will discuss different type of leverages. We will deep dive into leverages ratio. And of course, we will see another two ratios tomorrow, the valuations and operating ratios. So today is term of financial leverage or leverage ratio of a company. So the leverage ratio mainly study the company's debt with respect to the company's ability to service the long-term debt. Usually, most of the company takes loans in their lifespan, and here we will discuss whether company is a good position to serve that debt, pay on time, or company is in cash crunch. So how we can analyze and see the company's health in terms of leverage, financial leverage. So in this part, we will see four things mainly. The first one is interest coverage ratio. Second, we will see debt to equity ratio. Third, we will see debt to asset ratio. And final and fourth one will be financial leverage ratio. So all these four ratio we will see one by one and try to gauge the company's capability to serve or service the debt or repay the debt. So first is interest coverage ratio. Interest coverage ratio inspects the company's earnings ability. Of course, it the EBIT level before any depreciation, interest paid, amortization, all this as a multiple to its finance costs. So first thing we'll see the interest coverage ratio. Let us say our mind master financial ratio, profitability we have already seen. So today we see this leverage ratio. Under this leverage ratio is first one is interest coverage ratio. So interest coverage ratio will see how much interest or loan interest coming, company earning is more. For example, company is earning 400 rupees, but its interest liability is 100 rupees. That means company interest is covered four times through its earnings. That means company is in good position. If interest repayment is coming equal to earnings, that means company is in cash crunch because company definitely will other liability and due to anything little bit here and there, company will not be able to pay its interest. And if it is more interest than earning, then it is in bad state. Definitely company will default. There is maximum chance of defaulting. So this information we get through interest coverage ratio. And of course, this will come from profit and loss and balance sheet deep diving. Let us first understand these four things. Then we will go to screener.com. You can also go to annual report. There you will get 2 years. Better to go on screener.com, which I like most. Even you can go to moneycontrol.com or any other website. There are lots of websites which is providing ready-made data. From those data, you can analyze easily. Now comes to second part, debt to equity ratio. Sorry, I forget one thing to give you formula how interest coverage ratio is calculated. Interest coverage ratio is equal to earnings before interest and tax divided by interest payment. So what is earnings before interest and tax? It is simply EBIT, short form EBIT, earnings before interest, tax, depreciation, amortization. Or we can say simply earnings. Operating earnings is this one, and that is divided by interest payment. Then we will get interest coverage ratio. Now comes to debt equity ratio. Debt equity ratio measures the amount of equity capital with respect to debt capital. So, formula to calculate this one, debt to equity ratio is total debt by total equity. For example, if say here debt is 100 rupees and if company total equity is 10,000, say 10,000, then it will give you debt to equity ratio. And normally it should be less than 1. If it is less than 1, it is good, better. Second thing I would like to tell you, more than figure, important is its trend, whether the trend is in decline or upward, one thing. If it is in declining mode, even if it is more than 1, say if it is 2, then declining 1.8, 1.7, like this, something are coming towards 1 or going down 1, then it is good. Then we can think of investing in that very company. If trend is upward, that means even if it is 0.01, 0.02, 0.5 and increasing, maybe below 1, even though we have to deep dive and see why the debt component is increasing and it is an alarm. So more important is trend than absolute figure. Even if it is less than 1, but it is in the upward journey, then we should deep dive and see. And this is also a red flag. Third thing we can see comparison with this competitors. Every company have competitors in market. So with respect to competitors, how company is performing, whether other company is also having debt like this one in same segment, how their leverages are. If you are comparing with their competitors, peers comparison will give you fair amount of idea how company is performing in this sector. So three things is important here. First, absolute figure. Then second is trend, more important. And third, with respect to its competitors, how the debt equity ratio is. Same thing for interest coverage ratio also. Now, another part is, third thing is debt to asset ratio. Debt to asset ratio helps us understand the asset financing structure of the company, especially with respect to debt. A company having debt here, for example, 100 rupees, and its assets are, say, 5,000 rupees. Then, with respect to asset, how much it did? In case a company goes default, whether the shareholder will be able to get amount back through sale of those assets. That is why it is very important to note debt to asset ratio. So debt to asset ratio is calculated as total debt divided by total assets. And also again, we should see whether debt is constant, it's okay, or it is increasing year by year, or it is in decline trend, one thing. And with respect to competitors, how the debt is for this very company, debt to equity ratio for this company. So here also we will see all three parts. Then last part is financial leverage ratio. The financial leverage ratio helps us understand the extent to which the assets are financed by the owner's equity. And the formula to calculate is average total asset divided by average total equity. Why average total asset? Because in asset part, we can see there are some fixed assets and there will be some assets, work in progress, and again from year to year, there will be some depreciation. So all this calculated and average figure is found out, and then we calculate this financial leverage ratio from average total asset divided by average total equity. So now we have understand these four ratios. We should go to screener.com and then we will see all these four ratio there, how it is for forming any company. So here we see this Infosys. Here you can find in profit and loss account everything and balance sheet. For easy to understand, we simply go one pool, export to Excel. We have uploaded one sheet, calculated and uploaded one time, and we can see in any company. So here, all the four figure will find. The first one is interest coverage ratio. You can see here nothing figure coming because it is debt is zero. That is why coming like this. Here we can see interest coverage ratio is 128 times 135, 149. It is far better because there is no debt at all. Debt to equity, you can see 0.07%. So in comparison to company equity share, these data are very meager, almost negligible. We can say this is a debt-free company. So we can see here interest coverage ratio, wonderful. Debt to equity ratio, not less than one, even 0.1, very less, almost zero we can see here. And third thing, debt to asset, also we can find here almost negligible. And fourth thing, this financial leverage, also we can see up to three is allowed. Some people have takes four. Most of the people find it 2.5 less than 2.5. And this is also below that, this financial leverage. So all four parameters we can see Infosys doing wonderful. Let us see our example of ARBL, Amar Raja battery, how the Amar Raja battery is performing. So close this and we'll go to Amar Raja battery. Again export and we can see the figure. Again, we can see interest coverage ratio 44 times. Of course, here this is in declining mode. So we should take note of this and we need to deep dive why this interest coverage ratio is declining in downtrend because debt to equity ratio, we can see here increasing little bit, but far below. This is manageable. Of course, even 44.6 at 45, very good position. And this debt equity ratio, also it is a negligible. Financial leverage, this is also far below 3. So all four parameters, it is wonderful. Let us see this one company. We have usually seen this Suzlon. Sorry. Now you can see here interest coverage ratio in negative. So very bad situation we are. So we must be away from here. One thing positive here, we can see minus 2.96, minus 2. But here we can see last couple of years, little bit improvement. But even now, it is in bad shape. Only positive thing, this interest coverage ratio now become a little bit stable with comparison to older days, older years. That much. Debt equity ratio, again negative, bad. Of course, little bit improvement. That's it. Again, debt to asset ratio, even now, not good. Financial leverage in negative only. So everything here negative only. Only positive thing. It is now trying to arrest the bad thing now. And one can see if whatever bad with respect to student loan already happened. So maybe from here, company bottomed out and can improve. Future can be better. So only positive we can see from here, from leverage ratio analysis. Otherwise, even now, company is in bad shape. Let us see. We have seen good company, bad company. Let us see some more company. Reliance Industries. Now, here you can see interest coverage ratio. Of course, from last couple of years now, it is increased better with respect to earlier little time. Then second, debt to equity ratio. Here we can see 0.82, 0.79, 0.42, 0.41. So company is doing better now here. They are able to manage their debt better. Even it is less than one, but now it is in declining trend. So it is good thing in Reliance industry. Debt to asset ratio, again, we can see 0.21, able to this financial leverage with respect to earlier, able to do better now. So all four parameters showing company improving in their leverage management, debt management. So it is good sign for Reliance industry. Here, if reverse is happening with any company, company is increasing debt, their interest coverage ratio is declining, but debt to equity ratio is increasing, debt to asset ratio is increasing, financial leverage is increasing. If these three increasing and interest coverage is declining, then it is a red flag. We must deep dive and see why this is happening. And least thing we can do, we can exit that very stock. If you are not able to find, at least we can do, we can exit that very stock. So we have seen all four parameters, how we can analyze, how we can get data and take decision. If you got some value, please like and subscribe to this channel. Please share with your friends and colleagues so that they can also get some value from these videos. If you have any comment, please put that also. And if you want to cover any topic of your interest, especially this fundamental analysis, even technical analysis with respect to a stock market, you can write. Definitely, I will try to cover that also in coming days. Thank you. Bye bye.